Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Global stocks rally on optimism over China's reopening and slower rate hikes. Will the Fed need to rein in expectations once again? Brazil insurrection. Security forces regain control after thousands of supporters of former President Bolsonaro ransack government buildings in the capital, Brasilia. Plus, sources say Goldman Sachs will embark on one of its biggest ever rounds of job cuts this week, with plans to slash about 3,200 jobs. Now, first thing is first, let's check in on the markets and then go into some of these main top stories. The stock's definitely extending some of the global rally. So if we get the board up for you, I'll be able to talk about what the markets are doing right now. Now, we're seeing a lot of, rally really in risk assets driven by China's reopening, trade, and expectations of slower rate hikes. We had some pretty discouraging news in terms of data on Friday. That means there's a bit of change in expectations on what the Fed will do. European stocks gaining some 0.4%. Look at elsewhere. I think that the French CAC is pretty much flat. The US 10-year 3.59, and then we're also seeing quite a movement on crude oil, 80.73. This is for Brent. Now, if we dig deeper into the individual, not industries, but the individual countries that are actually doing the most or changing the most, I do think apart from the CAC and, of course, the IBEX over in Spain, that's pretty much flat. We're seeing modest gains. Now, global stocks rallying, driven by China's reopening and, of course, this expectation of slower rate hikes. It comes after Wall Street ended the day up more than 2% on Friday following a weak ISM services reading and slowing wage growth. The focus now shifts to this week's U.S. inflation data. Joining us now is John Bilton, JP Chase Bank, head of global multi-asset strategy, and Christina Kino, managing editor for markets. So thank you both for joining us. John, let's start off with you. When you look at the Fed, when you look at repricing, so bad news on data means good news for what the markets are expecting the Fed to do. Are they wrong?
I would say they're getting a little bit carried away with themselves because, let's face it, the Fed have done a lot of work over the last 12 months to really start to rein in inflation expectations, really get pricing under control, etc. And yes, we could be getting close to a pause, but there's not enough support for a pivot. And at the moment, you've got, particularly interest rate futures markets suggesting that the Fed are suddenly going to do a screeching J-turn and go and start cutting rates again. And we just don't have the setup for that today.
I mean, this means pushback time, once again, from Fed and FED officials.
Absolutely, Francine. It's very interesting, though, the message that we've gotten from the Fed. I think it's absolutely right what John said. I think we're too far from really taking a look at those Fed rate cuts that are already being priced into markets for the second half of 2023. And the message from the Fed is that markets shouldn't underestimate the ability to keep rates higher for longer. I think that really is the message that markets need to remember. Yes, there is likely going to be a slowdown in that relentless pace of Fed tightening that we saw in the second half of last year, but a pause is very, very different from rate cuts. And so long as markets remember that there is a key difference between those two things, then all could be smooth sailing. But as we know, markets like to exaggerate things, right?
I mean, this is about remembering, or this is about the markets realizing? Because we've heard many times the frustration from a lot of Fed officials in saying that just markets are too hopeful about the path ahead.
Absolutely, Francine. I mean, I think this is really the nature of markets. They like to kind of overprice a particular scenario and then have to reel that back in once we get that input from data and from Fed officials. And so this week is really going to be key because, again, we're going to get that U.S. inflation number following the all-important payrolls number from Friday. And, I think it really is what markets are really hoping for is kind of this soft landing, Goldilocks sort of scenario where, yes, employment is maybe pulling back a little bit, but not rapidly so. But inflation is also pulling back from those really high levels that we saw last summer.
So, John, where are you expecting the biggest opportunity? I know we're expecting quite a lot of volatility, and certainly you are. Is it the fixed income space? That's the one where you're going to see the most interesting bits.
Yeah, I mean, certainly for now. I mean, look, make no mistake, this is not 2022. Asset prices are lower, yields are higher, so there's more opportunity out there. Look across credit, investment grade. Look at the all-in yields. You can clip nearly 6% coupon at the front end. You get to European high yield, you're getting towards 8. Get towards emerging market debt, you're getting towards 10. These are equity-like returns from fixed income assets. And look at what the Fed are trying to do. They're trying to calm the market down. Not too much one way, not too much the other. That supports a carry trade. And so we think early doors, it's probably the fixed income space that's where you want to be looking for opportunities.
So you're still underweight equities?
We are at the moment underweight equities.
Across the board?
No, we're beginning to look at areas where we can lean into. I mean, Asian stocks at the moment, China's reopening, that's a really important feature. Also bear in mind some of the support given to the real estate market and the fact that we're seeing a little bit more outlook for a more sort of growth-oriented policy going forward. That's supportive for Asia in general. Europe also, it's been a warm winter. It may have caused problems for the ski season for certain people, but it's certainly caused a lot of support for the energy outlook. So there's less issue in terms of the gas crunch that some were expecting. That means it's not as bad as feared in Europe. Europe actually looks as if it may be in a little bit better shape than some had feared. So there are plenty of opportunities in equity markets, but bear in mind, we've yet to see the true impact of this economic slowdown around the globe on corporate earnings. And that's something, that shoe is still yet to drop.
Yeah, and we're spending quite a lot of time, Christine, also looking at some of the financial stocks. And of course, Goldman Sachs with the Bloomberg scoop saying, look, they're going to probably, fire around 6 to 7% of their workforce. We haven't seen that for a while. So is that really symptomatic of what the economy will live through?
It certainly seems like a lot of these industries are preparing for that worst case economic recession scenario. I mean, I think absolutely right what John was saying is that we really haven't seen the full impact of an economic slowdown or a recession scenario just yet in the real economy. And that's probably something that investors will have to remember, especially going into the second half, is that, we're probably going to have to brace for a slew of more job cuts, potentially some bankruptcies and defaults and things like that on the corporate sector. And that could be something that tempers this early optimism that we're seeing this year.
Is there anything else in terms of sectors that we should be watching out for as, I guess, an indicator as we get into earnings season? Is basically job loss or cost cuts as an indicator of, symptoms going wrong?
Absolutely, Francine. And definitely something that investors will be mindful of, particularly, I think, if there are any signs of these job cuts spreading beyond the tech sector, which we know has been very problematic. And banks, of course, make sense as well, because we've seen a lot of kind of buildup in employment over the last couple of years. Goldman says, of course, that's one of the reasons why they're having to cut some of these positions now. But if we're seeing signs of that spreading across kind of more generally into other sectors, then that really tells you that there is this massive widespread preparation among companies bracing themselves for a slowdown in the second half, and something that could potentially spread across different industries beyond these two, finance and tech.
John, when you look at some of the divergence, if you look at divergence in central banks, I mean, is this the big story of 2023?
Well, I don't think it's the big story of 2023. I think the cooling of inflation and the trajectory of the economy in general will be the big story. But make no mistake, it's really important for where you're picking where you want to put money to work. Because if we are right that the Fed are going to be among the earlier of the central banks to pause on rate hikes, then this weakness that we saw at the back end of 2022 in the US dollar could continue, could extend a bit further. Under those circumstances, some of the very much underperforming markets, particularly emerging markets, begin to get a little bit more support. We prefer to think about emerging markets as a full asset market, including the debt side as well. But certainly what it does is it removes one of the constraints to those emerging assets being able to perform.
All right, thank you both for joining us. Christina Aquino, Managing Editor for Markets, and John Bilton, JP Chase Bank Head of Global Multi-Asset Strategy, stays with us. Now, coming up, Goldman Sachs, as we were just saying, said to be planning big job cuts with positions in its core trading and banking units on the line. So we'll have plenty more on that story a little bit later in the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're back with John Bilton, JP Asset Management Head of Multi-Asset Strategy. He's still with us. We're talking a little bit about some of the pitfalls and actually what you're seeing in 2023. So first of all, the China reopening. I know it's not going to be plain sailing ahead, but do you play China right now, or are you still a bit cautious?
Well, I think that you've got to look at the longer-term outlook for this. I mean, China has been an economy which has been under lockdown for 2 years, nearly 3. It's been one which has been at the heart of some of the concerns we had around the global supply chain. Of course, there's massive pent-up demand there, and we do think that as the reopening takes place, then you will see a pretty significant economic boost. Chinese growth came in last year with a 3 handle. It's probably going to be back more towards the targeted level of the sort of middle 5s this year. That's a big deal for a global economy that's really looking for one of the engines at least to be running. So we do think that this is an important structural change here. In terms of how we play it, one has to take a little bit of caution, because with Chinese New Year coming up, the beginning of the mixing, we saw what happened in economies over here when we reopened. It's not going to be any different. So there will be bumps along the way. But this is an economy where, let's face it, it's likely to become, over the next few years, the biggest economy on the planet, yet it's been underperforming for a couple of years. This is a structural story, we believe.
John, when it comes to fixed income, how do you play Europe? So there's a divergence, and we're actually seeing spreads widening a little bit between, for example, German bunds and Italian BTPs. Are we going to see some of the political upheaval going back at the forefront this year?
I mean, look, you can never be too far away from political debate within Europe. But I think that we've got so many more levers that can be pulled. There's the redeployment of the next-gen package towards supporting consumers in more stressed countries. The ECB are pursuing an inflation targeting level. We've probably got a little bit more in terms of rate hikes. Certainly last year, Christine Lagarde indicated that they would keep going as long as they needed to. The euro is getting more supported, and generally the economy across Europe is in reasonable shape. The big issues that were facing the European economy, squeezes on consumers, particularly through energy and food prices, they've been dealt with in large part. So we do feel that if we're getting China and Asia reopening, then Europe will be a beneficiary as well. So there's reasons for some cautious optimism. There will be pockets probably across Europe where we will see some contraction, but the severity of it...
Countrywide, or does it impact...
We think certain sectors, certain countries may suffer more than others, but the reality is the risk of a sharp supply-side influenced recession that we saw in Europe, that seems to be abating somewhat. So the outlook looks a little bit better. But again, we've got volatility ahead. We've got some reason that we need to be a little bit cautious in terms of the deployment of risk. Look for opportunities where we can lean in. That means fixed income. That means credit. That means looking for where does the central bank want to, what does it want to achieve? It wants a calmer market, rates at a sensible level. That means clipping carry. I
want to talk about UK, and then if we have time, also Japan. I mean, the UK, if you look at Governor Bailey, it's not an easy task. It's probably one of the hardest in the G7.
It truly is. I mean, look, the UK has a more acute supply-side issue than many of the other nations around the globe. And it's highly likely that we will see further pressure on sterling over the course of the year. The UK has to continue to work through its negotiations with its biggest trading partner, and the outlook for the UK economy is one where we do see some squeeze on the consumer here. So it's not a pretty picture. And of course, if rates go up to tackle inflation, as we saw last October, that really hurts the mortgage market and then the consumer. It's an incredibly difficult balancing act. And the UK generally, we think, will probably see that economic weakness mostly come through in the currency.
So what do you do? I mean, there's also, though, a bit of concern that, foreign investors are not back in the gilt market. How does this play out?
Well, I think, we've got a weaker economy in the UK. It's likely that we will continue to see some significant demand for gilts from domestic pension funds, from domestic asset allocators, because, against a weakening economy, those gilts are now offering a reasonable return. So we do think that there'll be support there. It makes it more difficult for it to rally as hard as some other markets, perhaps, but certainly we don't see any shortage of demand in the gilt space.
Japan, I mean, that was, that gave us a nice Christmas present if you're working on the markets. Are you expecting, again, are the markets getting ahead of themselves?
I don't think so. Look, remember we've got, Governor Kuroda will be stepping down at the end of March, so certainly this was a little bit of a surprise that this move on the yield curve control happened when it did. But if you bear in mind where Japan's been targeting, it's been trying to get back up towards that 2% inflation target. They've achieved it, with a little bit of help from the wider global economy, of course. But under those circumstances, like every other central bank, they need to move away from that ultra-easy policy. Not as far as others, of course, but, we think that this is the first step towards possibly some modest normalisation in policy.
John. Thank you so much,
Thank
as
you.
always, for joining us. John Bilton there, JP Morgan Asset Management, Head of Multi-Asset Strategy. Now, coming up, UK Prime Minister Rishi Sunak set for talks with union leaders to resolve growing industrial unrest. We'll have plenty more on that story next, and this is Bloomberg. The UK Prime Minister Rishi Sunak is set for talks with union leaders today. That's as a threat of more widespread action hangs over the country. Well, joining us now is Bloomberg's Lizzie Burden in London with a roundup of some of the UK news. So, Lizzie, good morning. What exactly is the outcome that's expected from Sunak's meeting with the unions?
Well, he's meeting the rail union bosses in less than 10 minutes this morning. I should say it's significant that he's even meeting them because on Friday, Rishi Sunak said that he wanted to get round the table with union bosses for grown-up discussions. But you remember last week, the government said it wanted to introduce this tough anti-strike legislation. And in response, the unions said that they could introduce coordinated strikes involving tens of thousands of workers. So even more chaos than we've already seen. But he was speaking to the BBC over the weekend, and he even hinted at the possibility that he could negotiate on pay this year, not just next year, as we had heard so far. Take a listen to what he had to say.
We want to have a reasonable, honest, two-way conversation about pay and everything else. We're about to start a new pay settlement round for this year.
And we also heard over the weekend from The Guardian that the government's considering actually paying a one-off bonus to workers to help them deal with the cost of living crisis. That's something that Rishi Sunak's spokesman previously had ruled out. So you can see this hard line is starting to soften.
Yeah, it was also a really great comprehensive interview that he gave yesterday, and so many questions. I mean, I got so many texts saying, oh, he didn't confirm or deny whether he had a private GP. Where does all of this leave him politically?
Yeah, and such a hot question in the UK at the moment, whether people who can afford it should be paying for their health care. But where it leaves him politically is he needs to at least be able to say that he's brought the unions down from their original demands. Remember, the nurses wanted 19% raises. But more than that, he needs to stop the chaos from the strikes because it's dominating the news agenda apart from Prince Harry's memoir, and it's really frustrating his own MPs. He has said, remember, that he wants to halve inflation this year, and he also said in that interview that isn't a given, hence why he needs to negotiate very strongly with the unions now, and he's really staked his reputation on these 5 priorities, also including cutting NHS waiting lists, which really is a risky political strategy. He's told the public, judge me on what I deliver, and we know we've got to have a general election by January 2025.
And we'll also find out on how the government plans to, I guess, support businesses on their energy bills today.
Yes, and it could be today or later this week, we're not sure yet. But Jeremy Hunt has said that the current support isn't sustainable. It's too expensive. It's only expected to continue being worth about £5 billion. Now, this has caused massive consternation across industries. The manufacturers say that businesses could have to cut jobs. Hospitality says that some businesses could fold. And the Federation of Small Businesses says that small firms are particularly vulnerable to all of this.
Lizzie, thanks so much. Our Lizzie Burden there with the very latest here from the UK. Now, we'll also be covering all things UK every week on Thursdays at 9:30 a.m. UK time in our half-an-hour special. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's border reopening after 3 years of global isolation is sparking a homecoming rush for many Chinese citizens living overseas. Beijing has dropped quarantine for overseas arrivals, though visitors will still need a 48-hour negative PCR test. A resurgence in outbound travel may actually take longer as many countries do adopt stricter COVID testing requirements for visitors from China. Now, Kevin McCarthy, who became US House Speaker on Saturday after 15 votes, is rallying Republicans with pledges to champion spending cuts and also strengthen the borders. On Monday, the House votes on new rules, including a measure to allow a single member to force a motion to vacate vacate the speakership. President Zelensky says Ukraine is sending reinforcements to defend two frontline towns in the Donetsk region that he called among the bloodiest in the fight against Russia's invasion. On Sunday, Kyiv rejected as nonsense a Russian claim that 600 Ukrainian soldiers were killed in a major strike overnight. The rocket attack was said to be retaliation for a New Year's Day attack by Ukraine that killed nearly 90 Russian troops. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now we look at exactly what's going on in the markets. Partly, of course, is not only the rally in risk assets that we're seeing, but of course the dollar extending the drop from Friday. Again, traders now betting that the Federal Reserve will slow rate hikes with, for example, the Institute for Supply Management's Index of Services in contraction territory. That was the big story on Friday. Stocks overall extending this global rally in risk assets. Now, coming up, President Lula faces a big test amid extraordinary scenes of riots by pro-Bolsonaro protesters in Brasilia. That story is next, and this is Bloomberg. Global stocks rally on optimism over China's reopening and slower rate hikes. Will the Fed need to rein in expectations once again? Brazil insurrection security forces regain control after thousands of supporters of former President Bolsonaro ransack government buildings in the capital, Brasilia. Plus, sources say Goldman Sachs will embark on one of the biggest ever rounds of job cuts this week, with plans to slash about 3,200 jobs. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Brazilian security forces have regained control of Congress and other key government buildings after they were stormed by supporters of former President Jair Bolsonaro. Well, President Lula da Silva, who was away at the time, has vowed to punish those responsible.
There is no precedent for what these people have done, but these people will be punished. We are going to find the financiers, and they will all pay with the force of law for this irresponsible, undemocratic gesture, this gesture of vandals and fascists.
Now, for more on all of this, let's talk to Bloomberg's Rodrigo Orihuela. Rodrigo, thank you for joining us. So what do we know so far about what exactly happened yesterday?
Well, it seems from what the different government members and the justices have said is that there was quite a bit of police inaction that allowed as many as hundreds of buses with supporters to get into Brasilia, get very close to some of the key government buildings, including the presidential palace, the Supreme Court building, and the Parliament. And the supporters were able to break into this while the police took a very long while to act. And this has led Lula to declare what they call an intervention of the state of Brasilia, which basically means that they take certain powers away from the local government, mainly security, and hand it over to somebody who's named by the government to control it while they find a solution for this, and that will take about 90 days. And a lot of people have come out from Lula's camp and from others to denounce this and say that this was terrorism, which is the word that's being used in Brazil. And Bolsonaro himself, who is in the US, has been a bit more relaxed in his comments. He has compared them to other protests that existed under the previous leftist governments about a decade ago.
Yeah. So, Rodrigo, what actually happens next?
So one thing that happened last night, the Supreme Court, one of the justices in the Supreme Court ordered that the governor of Brasilia be removed. There is a feeling that he basically allowed this to happen because this didn't catch anybody by surprise. Supporters had been announcing for days that they would be holding a protest, and one of the state prosecutor has also ordered the arrest of the security secretary secretary or former security secretary of Brasilia, who was also a member of Bolsonaro's government. And then there's a lot of talk that the government will try to arrest more people. There's at least 20 who have been arrested. And Lula himself and others have said that they will follow the money to see who financed this.
So what exactly does that mean financially? Is there a potential financial ripple effect?
Well, right now, markets were slightly on edge already with Lula. They weren't too sure about where he's going. There are certain policies that he hasn't been clear about how he will enact them, or some that weren't welcomed by the markets. So the feeling is that this will create more uncertainty. There's a piece today by our colleagues at Bloomberg Intelligence who explain this very well, and Bloomberg Economics, and they say that there will be more uncertainty around what markets expect from the government going forward, whether it will be more interventionist, and this may have an effect today at the open.
All right, thank you so much. Bloomberg's Rodrigo Orihuela there with the very latest on Brazil. Now, Bloomberg has also learned that Goldman Sachs is embarking on one of its biggest round of job cuts ever. The U.S. lender is planning to cut about 3,200 positions this week. More than a third of those will likely be from its core trading and banking units. Well, for more on all of this, we're joined by Michael Moore. He's Bloomberg's managing editor for EMEA Finance. So, Michael, thank you so much for joining us. What areas in Goldman Sachs are likely to be more affected?
I mean, this is pretty broad-based. You're seeing it not just in the businesses that are struggling, but also the trading unit that's done quite well this year. So it's pretty across the board. We had reported earlier that there would be a focus on the consumer banking business, where Goldman is scaling back their ambitions a bit after a really strong push in that over the last few years, an expensive push. So that's one area that's likely to face outsized cuts, but it will be across the board.
So, Mike, how big a deal is this? This is what, 6 to 7% of the workforce, but it's actually maybe worse or a little bit better than it could have been, because we were expecting at some point almost 4,000 job cuts.
Yeah, there's been a number of numbers thrown out there, but it was going to be a sizable cut, and some of this is Goldman specific, but a lot of it gets back to something the entire banking industry is facing, which is in 2020, nobody really did many job cuts because of the pandemic, of the optics around that. 2021 was a hugely busy year, both on the trading side, on the investment banking side. Banks were hiring pretty aggressively to try to keep up with the deal flow. And now you've had things slow down. You have a more normalized environment, and banks that haven't done their usual annual cuts in a couple years. So there has been kind of this build-up, headcount growing at a lot of the firms, and with revenue not keeping up or not expected to this year, I think you might see this at a number of firms.
So would you call it like a normalizing adjustment or things like that? Or is it because Goldman Sachs, first of all, maybe earnings weren't as strong as expected, but also there's a worry, I guess, that a lot of these banks will go through a downturn?
Yeah, there is that worry that things are not going to be as bullish as they've been for the past couple of years, even if interest rates will help the lending side of these businesses. So I do think you'll see some of this across the board in the industry. Some of it is Goldman specific. They've been under pressure to rein in costs to make this consumer push a little less expensive. So some of that I would attribute to the idiosyncrasies of Goldman.
What are we expecting overall? We're going into earnings season. What are we expecting from a lot of these Wall Street banks?
I think the big question will be their sentiment toward the deal-making, backlog, and whether things will pick up in 2023 after there was a pretty significant slowdown in leverage lending, in deal-making, in IPOs, obviously. So how quickly can that come back in a recessionary environment? And what is this trade-off with the lending side of the business, which rates are going to help there, but you'll also see an increase in provisions.
All right, Mike, thanks so much. As always, Michael Moore there, Bloomberg's managing editor for EMEA Finance. Coming up, China's borders have opened after 3 years of global isolation, so we see how the markets are reacting to that. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China has reopened its border on Sunday, switching 5-day quarantine for a 48-hour negative COVID test result. It sparked a homecoming rush and lured investors back to the region. Now, for more on all of this, Sofia Orta-Costa, our chief China markets correspondent, joins us. Sofia, thank you for coming on TV again. Now, the border reopening, is this really a watershed moment for China?
It really is, Francine. I mean, this is the first time in 3 years that Chinese nationals outside China can visit their families. And it's not just the fact that they can travel from outside China, but also within China. And this is really the economic story, the big macro play for this year. Is the consumption revival within China. I mean, we just got the data from the Transport Department. I'm adding it up here. It's about 17 million trips were made in those first 2 days over the weekend, and about 2.1 billion trips are expected to be made during the Lunar New Year period. This is the key period it's the world's biggest migration of people. It's also the time when Chinese consumers are expected to have that consumption story really pick up. A revival in confidence. This is really important for the economy to pick up, and that's why we're seeing economists revise those GDP estimates for 2023 higher almost every single day, Francine.
So if you look at the tech crackdown in China, how much of a pivot is this? And are we sure that actually the crackdown gets tempered down?
Yeah, I mean, how many times have you and I spoken about that over the past 2 years? This is really different this time, and the reason is, I mean, we saw over the weekend Gu Shuqin, he's a very high-ranking official at the PBOC, China's central bank. He said that the tech crackdown, in his opinion, was nearing its end, and this is very strong words from a very high authority in China, really giving momentum to the China tech trade. You're seeing Alibaba close up in Hong Kong about 9%, just under 9%. And Alibaba is obviously the big story, the kind of the hallmark of the China tech crackdown. Jack Ma, a big figure there. And another reason also is because Jack Ma has lost control or given up control of Ant Group. The suggestion is that Alibaba's fortunes are not so interlinked with this slightly controversial fintech company that he was owning. Also, Morgan Stanley and Goldman Sachs both really raising their price targets for Alibaba stock this morning, and it's on Morgan Stanley's top pick list for the first time in 3 years. Francine.
Sofia, I know you're one, of course, of our great experts in terms of, thinking of Chinese economy, policymakers, and the like. How are you expecting the next 6 months to be? Is it going to be stop and start with a lot of these policies?
The only sure thing I can say is volatility. I mean, the problem is that people have been so scarred by what's happened over the past 2 years, not just when it comes to policy, but also the market performance. I mean, the confidence that you're seeing in markets, it's really just a mean reversion story right now. You're seeing that short covering. Morgan Stanley's quant desk has really good data on this. They're saying that the long onlys, your kind of long-term investors, the really sticky money, that's yet to come back. Flows are still low on that front. So really you can see the damage that has been caused by not just COVID-0, but also, let's not forget, common prosperity and the tech crackdown and the property market. I mean, the property market is still in the doldrums. That's still a story that China has yet to turn around. So investors will want to see the data that the economy is picking up, that consumption is picking up, and that Xi is really turning market friendly. We don't know that yet.
Sofia, thank you so much for the terrific briefing. Sofia Orta-Costa joining us this morning. Now, UBS's annual Greater China Conference is also currently underway, bringing together investors and top leaders in business and finance. Bloomberg's David Inglis sat down for an exclusive interview with the UBS Asia Pacific President, Edmund Ko.
With the exit of zero COVID and together with some of the growth initiatives, I think the power pack of some of the growth initiatives will only come possibly towards the tail end of Q1. And that's because there's massive migration or transmigration of people during the Chinese New Year period holidays, and also low productivity during the 15 days of Chinese New Year festivities, together with more infections, we think. So real growth will come in tilting towards maybe starting of Q2.
Talk to us about headcount, for example. We just heard from one of your peers, Goldman Sachs. They're looking maybe at some reductions in headcount. We all know, of course, your other peer, Credit Suisse, and the saga that they're going through. Are you looking to add talent this year, net?
We are. We clearly are. We are a different house. You know, when you are the preeminent wealth manager of the world, where we manage more than 3 trillion, I think it's absolutely important that when we look at all the elements before us, we are here to grow. And it's more of a franchise business than really hunting.
Okay.
So it's a very different setup for us than the other firms that you have mentioned. They are great firms, of course, but we are all on different paths as to how we craft out our strategy, etc. So for us, yeah, I'm here to hire.
Can you give us a number, rough percentage, in terms of, well, growth of the business and maybe what that manpower complement looks like?
I typically do not give forecast on numbers on headcount, simply because we are here to farm what is available, what is the best. Of course, we plan our own and grow our own in terms of graduate trainees program. That consistently we have been hiring every year. But for the rest, it really depends on the talent that are available and also the relevance to where we are growing in terms of sector and regional coverage. So it's quite different.
Business-wise, what do you expect to grow, though? Wealth management, asset management, IB. Is there any one of your major revenue streams that you feel most excited about?
I think our wealth management will power away this year because of what's happening in China, opening up and creating a more positive outlook for the whole markets, for investors. Investment banking, I think on the banking side should recover as well. And on the global markets, of course, volatility helps.
UBS Asia Pacific President Edmund Koh speaking exclusively to Bloomberg's David Inglis. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. UK trade union leaders have been invited to talks today in a bid to avert further strikes on the transport system in the health service and also elsewhere. This week sees a pause in the rail strikes, which brought the network to a standstill in the first few days of the year. It comes after the boss of one of Britain's biggest transport unions called for coordinated strikes involving tens of thousands of public sector workers. Now, Ant Group says it has no plans for an IPO and will focus on its business. The statement came after it indicated that founder Jack Ma is giving up his controlling rights in Ant as a billionaire further retreats from his online empire. The company is offering 10 individuals, including the founder, management and staff, independent voting rights, effectively removing Ma's control of Ant. Goldman Sachs is embarking on one of its biggest rounds of job cuts ever as it goes deeper than rivals in shedding staff. According to our source, the process will start midweek with up to 3,200 positions affected. More than a third of those will likely be from within its core trading and banking units. And Richard Branson's Virgin Orbit says it's on course for Britain's first ever space launch this evening. After completing a vital wet rehearsal, the modified Boeing 747 jetliner named Cosmic Girl is set to climb above the clouds before the rocket blasts away. The new mission from Newquay in Cornwall will deploy 9 satellites for a whole range of customers. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, rampant inflation and continuing recession fears. What's the outlook for companies? We take a look at the 50 firms to watch in 2023. That's the big take. That's next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, with inflation sticking around and recession fears running rampant, what's the outlook for companies this year? Well, Bloomberg Intelligence has been hard at work compiling a list of 50 companies to watch in 2023. And joining us now is Tim Craighead, Director of Research Content for Bloomberg Intelligence. Tim, as always, thank you so much for coming on. So this is exciting. 50 companies that we need to watch out for this year in the next 12 months. How did you select these companies?
Yeah, so Francine, this is is a list that is primarily from our broader list of focus ideas. And what makes that up? It's companies where we have a really strong fundamental view. We think it's different from the market. But importantly, they're catalysts ahead to change perceptions. And this list, which spans all regions, all sectors, some positives, some negatives, is a list that focuses on those triggers in 2023.
Okay, so one of the themes, of course, is management change. Which companies should we be looking out for?
Yeah, there are three in particular that come to mind, and you think about what can get a company beyond the current turbulence and economic uncertainty that we're in, and a management changing focus is a big deal. Adidas has a new CEO coming in now over from Puma, where he did great things. Yep. We're looking for new endorsements, new kit, new product, etc. Another one is Prudential here in London. You think of it as a UK company, but it's not. It's wholly focused on Asia now with a big restructuring. They have a new CEO coming in February that we think can take this a leap forward, which is also an interesting play on China. And then think Disney. Don't really need to go through this one. Bob Iger's on board. It's all about streaming now. Yep. It was hero to zero with the pandemic. We think there's a new leaf in the story coming out in 2023. In
terms of big themes, of course, EV is one of them.
Yes.
And that's not going to change.
No, I tell you, it's accelerating, if anything. Porsche, IPO last year, it was a big deal. We see a further acceleration in its shift to EVs this year. And you could see almost half the revenue coming from EV, half the production coming from EV in a couple of years. Another one is CATL, which a lot of people may not be familiar with, but it's actually the largest EV battery manufacturer globally. They feed into Tesla, they feed into Porsche, they feed into everybody. And with China really pushing EVs now as part of their stimulus, it's a big deal. It's not all positive, though. No. Allison Transmission, U.S. company focused on mid-sized trucks. That's another segment of the market that's going EV. Their traditional business can see a lot more competition.
So, Tim, the other thing, of course, is chip and tech, which we talk about day in, day out. Some of the supply chains have been heavily hit. What are the companies you're watching out for in that?
Yeah, this is, I think, a really interesting area because you've got the supply chain concerns between U.S. and China. You've got economic concerns about demand, valuation hit because of interest rates, etc. But with that, you've got some big companies, leading companies that have been pummeled, whose fundamental position as we look ahead, I think are quite bright. Think TSMC, the world's largest foundry. Think ASML. You can't make advanced chips without their technology. Microsoft is another one that's gotten absolutely blitzed, but yet cloud computing, is a big deal as we look forward.
Tim, thank you so much. And of course, Tim's piece is on the Bloomberg terminal, also on social media, and we'll push it out. Tim Craighead, Director of Research Content at Bloomberg Intelligence. Now, coming up a little bit later today, Rolls-Royce Chief Executive Officer Torsten Müller-Otvos joins us to discuss the company's annual results. That interview live at 3:30 p.m. UK time, 10:30 a.m. in New York. We'll have plenty more, of course, Bloomberg Surveillance Early Edition. It's Matt Miller, Kelly Lyons, and Anna Edwards. This is Bloomberg.
As we move further into this year, as the environment gets increasingly challenging with the high rate environment, with the clouds hanging over the broader growth outlook, you're going to see businesses get more cautious.
This is going to be remembered as a V year when we recognized that we were headed into a different kind of financial era.
We will probably see that recovery within 2023, but not soon.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kaylee Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Stunning violence in Brazil's capital. Security forces have regained control after thousands of supporters of former President Bolsonaro stormed Congress and the presidential palace. A ship that ran aground in the Suez Canal has now been refloated. That reopens one of the world's most crucial waterways for global trade. And it's one of Goldman Sachs' biggest rounds of job cuts ever. More than 3,000 jobs will be eliminated at the Wall Street firm. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment. Matt, good morning to you. It seems that animal spirits reignited by, well, weakness in US data.
Yeah, absolutely. The rally that we saw last week at the end of the week on Friday was the biggest we've seen in a month in U.S. stocks, and that optimism really made its way around the world. We see big gains in Asian stocks as well. It helps, of course, that they've dropped their COVID zero policy and they've dropped quarantines to enter the country. So now there's an influx of people, a lot of, I guess, families reuniting as Hong Kongers come back to the mainland. So that's part of the rally. MSCI Asia Pacific gaining about 1.7%. The Hang Seng up a little bit more, 1.9% this morning. The Nikkei in Japan is making some smaller gains as well. And we see the dollar today strengthening against the yen. Right now, 132 yen is the amount you can get for $1. Remember, we were all the way up at 146, 147, but we've been down in the 120s as well. In terms of U.S. futures, we are up this morning. It's not the same thing as you see in the Asian session, but of course we had ours on Friday, so now we're up 1/3% there. And we really see moves that set us up for a bigger rally. You see a weak U.S. dollar. That's adding to gains in crude. It's adding to gains in Bitcoin right now, 17,247. So actual movement there on Bitcoin out of the $16,000 range. I will say, though, that as investors sell debt, the U.S. 10-year yield is rising, and those rising yields rival, of course, the yields that you get in stocks. So setting up a little bit of a competition there. Anna, what do you see in terms of the European markets?
Yeah, as US futures push a little higher, we push in aggregate a little higher on European equity markets, Matt, even though the picture across the map is a little mixed right now. Flat markets, negative markets in some places, but otherwise seeing some strength. Scandinavia looking pretty strong. The French market being down, weighed downwards by a downgrade on Danone, which is a food business, of course, heavily weighted in that particular market. So a mixed picture, but overall making gains lifted by the weaker data out of the United States having an impact on expectations around interest rates, but also, as you point out, Matt, the strength in the reopening story coming out of China. And it's the latter of those that's perhaps pushing higher on Brent crude. You mentioned, Matt, the dollar impact, that's in the mix too, but also the growth story out of China finally lifting Brent. It hasn't been something that has been lifting commodity prices, and commodities actually were a bit confused by the mixed nature of the data we got out of Friday's US session. Over to Brazil, though. Let's have a look at what we're seeing on a London-listed ETF of Brazilian assets. This in relation to, of course, the weekend's developments, the violence we've seen in Brasilia. And so as a result, those Brazilian assets listed here in London down by 2.2%. This is an interesting story. A small games developer here in the UK, small in market cap terms, but is having an impact on other games developers, which is why I put it on my board today. Apparently not as many people playing the F1 manager game as they'd anticipated. This business is the maker of that particular game. And as a result, very disappointing performance, they describe it as. And that stock goes down by 40%. AstraZeneca down 1% today. But this is a business that is doing deals. It's doing deals in the biotech space, spending $1.8 billion on a US biotech business, and that being well received by investors, but the sector a little bit weaker today on what is a risk-on session broadly.
All right, interesting stuff, and I'll check in personally to the F1 management game there. Let's get to the big story of the morning. Brazilian security forces have regained control of Congress and other key government buildings after they were stormed by supporters of former President Jair Bolsonaro. New president, Luiz Inácio Lula da Silva, who was away at the time, has vowed to go after those who were responsible.
There is no precedent for what these people have done, but these people will be punished. We are going to find the financiers, and they will all pay with the force of law for this irresponsible, undemocratic gesture, this gesture of vandals and fascists.
For more on this, let's get to Bloomberg's Rodrigo Oruela. Rodrigo, what has been the reaction in Brazil? We heard Lula's comments just now. We know he, wants to press charges to the full extent of the law. What else are we hearing?
Well, we've heard a lot of people come out who are not part of the Lula camp, who were close to Bolsonaro during his time in government, all come out and say, denounce this in some way or other, say that this should not be happening, that this is wrong, this is illegal. The word that's being used widely in Brazil is terrorism to refer to this. And on the more kind of specific legal side, one of the Supreme Court justices during the early hours ordered that the governor of Brasilia state be removed temporarily from his position. So this adds on to Lula's decision to intervene, as they say in Brazil, the state's power to control security forces there. So that's the biggest political move. And there was also an order from a prosecutor to arrest the security secretary of Brasilia state, who was part of Bolsonaro's government in the day, and whose whereabouts are unknown, though there is some talk that he's in Florida, which is where Bolsonaro is as well.
And I know you mentioned some of the wording being used here. I know that some have called this a coup attempt as well. Coming just 1 week after the inauguration of the new president, the old but new returning president, Lula, of course. And up to now, a lot of the focus in terms of assets then, Rodrigo, had been on whether we were going to see more fiscal spending coming from the administration. How is this changing thinking around Brazilian assets?
Yes, so we actually have a quite interesting reaction today from our colleagues at Bloomberg in economics on this. There was obviously some uncertainty when Lula took over as to where he was going to go with his economic agenda, and this put markets a bit on edge. Some of that has relaxed since then, because he has indicated there are certain things like labor reform that he will not push ahead with. So the initial kind of decline in the real relative to euro had eased. However, the conclusion in this reaction is that there is likely to be more uncertainty, which is negative for the real, is negative for stocks, unless the government makes pretty clear in some way or other that they have completely done away with these protests and the situation and put it under total control. Obviously, that will come down to seeing how the security forces act over the next few days and what kind of control the government has over them. But until that happens, there will be some uncertainty. The faster that uncertainty is put to bed, the faster markets will likely calm down and go back to where they were last week.
Okay, Rodrigo, thank you very much. Bloomberg's Rodrigo Orejuela with the latest on developments in Brazil. Another developing story we've been keeping an eye on, certainly in the early hours of the European morning. A ship has been refloated after running aground in the Suez Canal and briefly disrupting traffic in the waterway that's vital for global trade. Bloomberg's Danny Berger has been taking a closer look at what happened here. Danny?
Yeah, and I know we're all sort of longing for the simpler time of 2021 when the biggest story was just a ship stuck in the Suez Canal, but this really isn't that. First of all, it only took about 6 hours to get this thing, 4 hours rather, to get this thing up and floating again. It was just described as a technical failure. The Ever Given in 21, that took 6 days. So the impact here, I mean, you really can't compare them at all. And for what it's worth, this ship this time around, there wasn't really the risk that it would get stuck. It's half the size of the Ever Given. It held up about 20 ships. They're now back on their way just after delay. And the Ever Given, you'll recall, in 2021, it blocked about $10 billion worth of marine traffic every single day. So this time around, things are up and moving again. A completely different story, Anna.
Danny, thanks very much. Danny Berger with the parallels and lack of parallels with March 2021 and the Ever Given. Thanks to Danny for the update there. Now, Bloomberg has learned that Goldman Sachs is embarking on one of its biggest rounds of job cuts, planning to cut about 3,200 positions this week. For more, we're joined by Bloomberg's finance managing editor, Michael Moore, who has details for us. Michael, good morning. Give us a sense of how widespread, actually, this is. Which are the areas that are being affected by these job cuts?
Yeah, it seems like you're seeing it across the firm. Obviously, we've reported before that the consumer banking business, which has been an expensive push, is going to take the brunt of this in terms of at least proportionally. But you are seeing it in the banking unit, the trading unit that's done quite well this year. So it does seem to be across the board. And some of this might be, a couple years worth of cuts that have kind of built up. In 2020, there was the pandemic. Not a lot of banks were cutting jobs. In 2021, it was perhaps the most active year ever. Banks were staffing up to try to keep up with that deal flow. So this is kind of, there's been some buildup, if you will.
We have, obviously, U.S. banks starting to report as well. a massive amount set to come out in one day. What are you expecting there?
Yeah, I think, what we've seen is the investment banking side has been pretty slow. We're looking to see, if there's going to be optimism for whether that changes in 2023. Interest rates are helping on the lending side. The question is, how much is that offset by credit provisions, and do the banks, take a conservative view toward the economy and need to put more money aside for that?
You have 6 big banks coming on the 13th. Michael, thanks so much for joining us this morning. Bloomberg's Michael Moore covers banks for Bloomberg. Now let's get a look at some of the other stocks moving in pre-market trading in the U.S. this morning. First off, we're watching the iShares MSCI Brazil ETF. After the turmoil in Brasilia, it seems as though things are still being sorted out there, although fortunately all of the government buildings have now been, I guess fortunate depending on whose side you're on, have been freed up there. And right now we see that iShares MSCI Brazil Index ETF down about 1.2%. Next off, NVIDIA. Very interesting story here in big tech. And remember how big NVIDIA actually is. Cathie Wood's flagship fund, ARK, of course, sold more shares as the chip maker rebounded from a nearly 2-year low. But NVIDIA is still a $365 billion stock. So this is a company that is bigger than Tesla. And speaking of Tesla owners, swarmed showrooms in China over the weekend to complain about missing out on another round of price cuts. Those vehicles, some of the vehicles that Tesla sells in China are 40% lower than the same vehicles in terms of price made and sold here in the U.S. Anna.
Yeah, you're not getting over that one quickly, are you? That was one of our themes of last week. Coming up on the programme then, Matt, we'll talk to Karim Chedid, an investment strategist at Blackrock. If you think inflation is going to be sticky, if you think that Tesla prices stay high, what does that do to your outlook for bond markets? And we'll also delve into the outlook for corporates this year. 50 companies to watch in 2023. Coming up, we'll dive into a few of the details of which companies Bloomberg Intelligence has picked out on their watch list. This is Bloomberg.
This is Bloomberg Surveillance, early edition. I'm Matt Miller in New York. Anna Edwards in London. Kaylee Lyons is on assignment. And we are still, wondering over and pondering what the labor report that we got on Friday means for the Fed and for the broader markets. We had average hourly wage growth slow, but it's still climbing. And we had unemployment come down to 3.5%. That's the lowest level going all the way back to before even I was born, in the 60s. Joining us now to talk about what this means for the Fed is Bloomberg's macro strategist, Simon White. Simon, I can't help but think about NAIRU, the non-accelerating inflationary rate of unemployment. It's got to be higher than 3.5%, right? Which means that we're still looking at inflationary numbers.
Yeah, I mean, it's kind of interesting dynamics we have right now. You have, as you say, you've got this very low unemployment rate, but you have very big changes after COVID. So since the last 3 years, payrolls has added about 2 million, which compared to the civilian labor force, which is maybe up like 5 million, it's a shortfall. And the participation rate we know has gone down. And really, it's been concentrated amongst the older workers, so like 55 plus, people that left the labor force after COVID and probably have no real desire to return. And that's really changing the dynamics. That's going to make the Fed's job a lot more difficult.
And it's something that labour markets here in the UK have in common. There are differences, of course, but one of those themes, at least slightly in common with the US. So somebody found something kind of Goldilocks about what we heard about the labour market maybe on Friday. But also we got that services ISM print, which was really dire. And other people point to that and say that's actually what stocks rallied on. And was that well placed? Was it a good idea to rally on such dreadful sort of forward-looking data about the US economy? Sure, it impacts on what the Fed will do, but doesn't it just tell us something about how quickly recession is approaching?
Yeah, I mean, it doesn't make any sense because, you know, I think it's very difficult to get a Goldilocks scenario in the first place. But if we even are in that situation, the Fed is going to try and keep higher for longer. So it can't really be a good thing for stocks. But I would focus on what's leading here, right? So the services ISM is leading. New orders component within the ISM is also leading. That collapsed too. And if you look at leading indicators, you look at the temporary help, which is the part of the payroll and jobs report that's the most leading, that actually jumped to negative growth. So we've now got negative growth in temporary help, and that leads to the overall jobs market. So all the leading indicators are telling you that maybe we've added, you know, it's a 3 months extra kind of timeline to this, but the inevitability that jobs growth is going to start falling, probably in the second half of the year, is very high.
Simon, we had a number of big names come out last week and warn that the Fed needs to be on lookout for lower than average inflation or even disinflation. You had the sensational Michael Burry tweet saying that in the second half of 2023, we're going to be in a recession by any measure. And then you had Raghuram Rajan, who has been saying for a while that the Fed needs to get ready for this kind of move. Are we expecting, you know, inflation to come back down to earth and maybe even move lower in 2023?
It could happen. I mean, it's, you know, I don't think inflation is necessarily mean reverting, but it can display some of these characteristics where things do overshoot when they go back. So I think you could have a possible period in the second half of this year where it does look like it's heading considerably lower. I don't think it's going to head to like extremely low levels, say sub 2%. I think what it'll do, what it did in the 70s, the mid 70s, is it basically troughs at a slightly higher level. So maybe it gets down to just pick a number, I don't know, 3-ish, 3.5, 4, and then kind of troughs, and people then start to worry about what happens next. It starts to rise again, and because it's rising from a higher plateau, potentially it makes yet new highs later on in the cycle.
OK, so if inflation troughs at higher levels, then, Simon, I mean, where does this leave the Fed in its assessment? We hear from Chair Powell tomorrow. Is he going to want to push back on some of the market response we've seen to data, which has been pretty risk-on?
Yeah, I think so. I mean, look, they kind of want to make absolutely sure that they get the job done. Unfortunately, they focus on lagging indicators, so there's a very high risk that they do too much. And they push the economy into maybe a deeper recession than necessary. On the other hand, I think if they really do want to crush inflation, and they want to do that first time round and not have to go through what happened in the 70s where there was a few iterations, they probably do need to raise rates even more, like maybe another 1 or 2%. But it's not really going to happen, right? They've not really got the mandate for the deep recession that they probably need to fully snuff out inflation. OK,
doesn't seem to be what the market is dwelling on today, at least. US futures pointing another 0.5% higher. Simon, thank you very much. Bloomberg's Simon White with the latest on the markets. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Let's keep you up to date with the news from around the world. Here's the first word. In the UK, Prime Minister Rishi Sunak meets today with union leaders behind the strikes that have hobbled the country. Sunak is trying to avert further walkouts by rail, health, or other workers. Unions want immediate pay hikes. According to The Guardian, Sunak may be open to a one-time payment to workers. China is trying to change the narrative that nationwide protests prompted President Xi Jinping to abandon his COVID-0 policy. According to a timeline published by the official news agency, the leadership started relaxing COVID restrictions before the protests began. On Sunday, China reopened borders that were largely shut for almost 3 years. And billionaire Jack Ma is giving up controlling rights of Ant Group. It's a sign that Ma is retreating further from his online empire following China's tech crackdowns. He's mostly disappeared from public view since giving a speech that criticized Chinese regulators on the eve of the scuttled Ant listing in 2020. Meanwhile, here in the U.S., on Capitol Hill, new House Speaker Kevin McCarthy is rallying Republicans with promises to cut spending and strengthen border security. Still, in order to win the position, McCarthy had to give more leverage to the party's right wing. He promised a rule change that would allow a single lawmaker to call for a vote to oust the speaker. So I believe they will vote on that today, and it'll be interesting to watch this Kevin McCarthy's tenure kick off after he needed 14 votes to be elected Speaker of the House.
Yeah, absolutely. So eventually getting there, taking days and breaking with sort of history and precedent in taking quite so long to elect a speaker, and really underlining the difficulties that the House is going to have in passing any kind of policy, given the power that now exists with a number of people, and really changing our assessment perhaps, or making us revisit our assessment of what the midterms meant. We focused a lot at the time perhaps on the reduced influence of the former President Trump, and maybe not enough on the composition of the House. Right, coming up, we will get back to markets. Karim Chedid joins us from Blackrock. What's his outlook for inflation? This is Bloomberg. This is Bloomberg Surveillance 30 edition. Here's what you need to know. Stunning violence in Brazil's capital. Security forces have regained control after thousands of supporters of former President Bolsonaro stormed Congress and the presidential palace. A ship that ran aground in the Suez Canal has now been refloated. That reopens one of the world's most crucial waterways for global trade. And it's one of Goldman Sachs' biggest rounds of job cuts ever. More than 3,000 jobs will be eliminated at the Wall Street firm. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is on assignment today. And US futures point higher, European stocks in the main on the rise. Then, Matt, as we focus on perhaps some of the Goldilocks elements of the US data and the China reopening story.
Yeah, it seemed investors were pleased with the fact that wage growth slowed in the Friday non-farm payrolls report. And as a result, we had the biggest rally that we've had in a month in U.S. stocks. Now, Asian stocks were up overnight. European stocks are gaining as well. And we have S&P futures rising about 0.4%. The yield on the 10-year is coming up, though, to almost 360. Right now, 359.30 as investors sell debt. Now, usually I feel like if they're selling debt, they have money left over to buy stocks. On the other hand, you do have a higher rate on the 10-year to compete with the yield that you get on stocks. So there's always that one hand or on the other hand story with the relationship between stocks and bonds. NYMEX crude rising as the dollar weakens, and really dollar weakness is a great risk-on indicator for stocks today. We really do see dollar weakness. As a result, anything that's priced in dollars seems to be rising. West Texas Intermediate up to $76.24 a barrel. Bitcoin rising as well, out of that $16,000 range, now at $17,262. In terms of should we look at the pre-market movers here? We're always watching what happens around global turmoil. You have the problems that we saw in Brasilia with supporters of Bolsonaro storming not only Congress there, but the Supreme Court and the presidential palace. As a result, the ETF that follows Brazil stocks is down, although those demonstrators, I guess you could call them demonstrators, have been pushed out, and 400 arrests were made. NVIDIA right now up 1.6%. So NVIDIA showing gains, even though Cathie Wood's flagship fund, ARK, sold more shares as the chip maker rebounds from nearly two-year lows. It's a $360 billion stock. So it's worth even more than Tesla. Tesla gaining as well, almost 2%, even though Tesla owners swarmed showrooms in China over the weekend to complain about missing out on another round of price cuts. You can now get some models that Tesla produces in China for 40% less than U.S. consumers will pay for those models made in America. Anna, what do you see in terms of European stocks?
Yeah, well, a couple of stocks there moving despite the news flow then, Matt. We've got European stocks moving higher, up by 0.4%, but actually a lot of dispersion, a lot of variation around that theme. Broadly, the China reopening story and some of the data out of the US being weak enough to trigger risk-on sentiment, seems to be what is lifting markets. But we do have a lot of divergence between France and Spain on the one hand, and the Scandinavian markets doing much better. Brent crude is up, and energy stocks are that's one of the sectors that is moving higher. Brent crude is up by 3%, perhaps deciding to focus on on the reopening story out of China. It's been a difficult thing to try and pin down the relationship between that story and commodities. It's not been entirely linear. This is the iShares MSCI Brazil ETF listed in London. So, Matt, you were talking about one of the pre-market ETF moves that you're seeing Brazil-related assets there on the move in the US. Well, here we're open and trading, of course, in London, and this is one of the ETFs that reflects that negativity around the politics. AstraZeneca is down by just over 1%. They're doing deals, AstraZeneca, over in the United States, spending $1.8 billion US, which is maybe kind of small for a business the size of AstraZeneca. And analysts actually responding pretty positively to what they're doing here, but this is a sector that on a risk-on day is struggling a little bit here in Europe, Matt.
All right, so we'll keep paying attention to those stocks. Right now, I want to get to the bigger market picture with Karim, Chedid, Blackrock, head of investment strategy for iShares EMEA. Karim, thanks so much for joining us this morning. Let me first ask you about that supposedly Goldilocks number that we got on Friday, the non-farm payrolls report. We added more than 200,000 jobs, but it was the least amount added in 12 months, and the average hourly wage growth slowed. Does that mean that inflation is going to be kept under control and the Fed can ease off its monetary policy increases?
Not quite. I mean, when we look at the payrolls number, I think, as you said, the Goldilocks term is coming back. They're not too hot, not too cold, coming back into all market commentators' lingo. But I don't think it's time to bring back the Goldilocks playbook, market playbook, as it were, because this is different to the Goldilocks of the past decade. On the one hand, we did see that wages are coming off a bit, but when we consider where wages are relative to the Fed inflation target of 2%, we're still quite some distance from where the Fed wants it to be. So I don't think this is the mix that's going to get the Fed to back off. I think the Fed is very much focused on the hike and hold this year, as opposed to the reversal to cuts that the market is pricing in. So not the Goldilocks risk rally that we'd expect.
OK, so Karim, I spoke to good morning to you. I spoke to a couple of guests this morning who've been talking about the pace at which they think inflation is going to be coming down. One guest on Bloomberg Radio earlier on today was saying he's really in favour of fixed income right now because inflation is going to be dropping. I don't sense that you think inflation falls to such, more normalised levels.
So I think, it's all about the trajectory. So the drop from the peak to, say, 6% is much easier than the next leg of the drop in inflation down to that 2% that the Fed is still targeting. I think that next leg is going to be a little bit more stubborn. We're getting quite excited about the disinflationary figures that we're getting, and obviously we have the CPI on Thursday, so more to come. But I think that next leg might surprise markets in how persistent it could be.
So does that limit your enthusiasm for fixed income then, as a result?
So actually, we do prefer fixed income to equities. We do have an overweight on fixed income. And I think in that fixed income overweight, it depends where you're looking at. So duration might still be a bit more challenged for the points that we're discussing now around inflation and around just how carried away markets have gotten in terms of their pricing of the Fed versus what we think the Fed will do this year. But there are other pockets of fixed income that look pretty exciting, like credit, where we have a very strong preference versus equities.
You're not concerned about a jump in defaults this year? I know Matthew Mish at UBS, for example, has forecast we could get to 9% in terms of defaults. And even if you look at, other areas of credit, you've seen, for example, banks start to raise loan loss provisions. You've seen more leveraged loans last year than you did any year since, I think, 2007. So, you're starting to see the cracks appear.
Mm-hmm. Yeah, I mean, there are certainly some signs of stress starting to appear. And usually when you head into a recession, which we do think is playing out at the moment, you do want to be a bit more cautious with the credit risk that you're taking. But, when you look at credit spreads, IG is an area where we do have conviction. We do think that the valuations compensate you for those risks. And then when I bring it back to what we're seeing in ETF flows and what investor positioning looks like, like. It's been a pretty interesting ride for credit ETFs. If you look at the second part of 2022, 2022 was a big year for fixed income. We hit a record with fixed income ETF flows. The first half of the year was all safe haven into duration exposures, especially dollar assets. But the second half, and this is carrying into the first week of 2023, is a surge into credit buying, especially because these pockets of the market are yielding something when for a very long time they didn't.
Do you like credit better than equities because of the risk in terms of earnings? I noticed that bottoms-up analysts are expecting $230 this year for the S&P 500. Top-down analysts are looking at more like 210 or even 200.
Yep.
There's a big divide there. And I guess, Q4 earnings are about to kick off, so we'll get a taste of what's to come.
Yeah, I mean, I love the divide that you just highlighted. It does show why in equities you got to be selective in this environment as opposed to really focusing on that macro top-down equity call, which is why we remain underweight there. But when you think about that credit to equities preference, absolutely, you hit the nail on its head in that we do like credit more than equities in a recessionary environment, especially where earnings have so far held up better than expected. So the pain in earnings has not come yet. The season kicks off on Friday. We do expect Q4 growth to hit 0 or less in the US. Europe, the mix is a bit different. Europe has had tailwinds from a weaker euro for the large caps, which have boosted numbers more than expected so far. But the pain is yet to come in earnings. It's all got to be selective on sectors as well.
So pain is still to come on earnings. And one of the areas of the European earnings space that had benefited Europe last year was energy, of course. And
yep.
We saw that part of the European equity landscape doing pretty well. Does that continue, despite the fact we've seen certainly gas prices coming off highs?
Mm-hmm. Maybe not to the same extent of 2022, although I do think, for the energy sector, the integrated energy sector in Europe, there can still be opportunities, especially given that we haven't seen the full effect on their profits in 2022. That's still carrying forward. One other area in European equities, while talking sectors, is luxury. That's starting to come up as, you don't typically expect those types of consumer sectors to do well in a recession. But luxury,
China.
Yes, China tailwind of reopening, foot traffic back to luxury goods and stores in Europe is on the rise. So the data is suggesting that this sector is also well positioned.
And we eventually might see more Chinese travellers into Europe, which would be another thing to watch. Thank you so much, Karim. Good to see you. Thanks for joining us. Karim Chedid here in the studio in London from Blackrock. Coming up on the programme, the top 50 companies to watch in 2023 as picked out for us by Bloomberg Intelligence. We'll dive into a few of the stories behind their big tech story today. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former US Ambassador to Mexico, Tony Garza. That's coming up later in programming. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is on assignment today. Now, from Disney to Porsche, Bloomberg Intelligence has identified 50 companies worth watching this year based on growth prospects, management changes and plans for new products and services. Bloomberg's Joe Easton joins us now to take us through the detail. Joe, before we get into any stock specifics then, what are the broader themes? I mentioned a couple of them. What are the broader themes that have helped companies sort of qualify for this 50 to watch list?
Yeah, so I think what we'll see is a kind of repricing of some of the issues that we saw last year. So we're looking at areas like real estate, got a few companies in there, particularly in the UK, and also renewables, which is another strong area in the report from BI. And then the China reopening still plays into the big thing. So there's a few companies on there that stuck out, like Prudential and areas of the financial services sector exposed to Asia could see a bit of recovery. So I think it's those beaten down sectors that are sticking out in this report.
OK, and what about specific companies? We've got a few of them on that graphic for our radio audience. Well, I won't read them all because there are 50, but take us through a few of the highlights.
Yeah, so a couple for me that stood out. Glencore's an interesting one in the UK. This is really because their coal business is doing well, which is kind of something that nobody really expected. Coal was kind of the energy sector that was sort of seen as in the past now. But given gas prices have gone up so much, coal is now seen as a short-term kind of stopgap for the sector. So that's an interesting one, bit of a strange one. Novo Nordisk is on there because they're doing very well in the obesity and diabetes sector, which is really strong. There's a lot of excitement around that among analysts. So those are probably two of the stocks in Europe that I like the most.
I love the coal theme, right? Who would have thought that global warming would be celebrated for thwarting an authoritarian dictator making a war in Eastern Europe? Let's talk about some of the U.S. stocks, though. Netflix is one that I think is interesting. As you know, it's such a volatile stock, hinging on, I guess, subscriber numbers and the kind of margins that they can keep.
Yeah, that's right. And I mean, we saw that huge sell-off in subscriber numbers and the stock price around, I think it was around 6 months ago. And it's now kind of stabilized a little bit in terms of the numbers that they report on the quarter. So the next thing will be whether there will be another hit to those subscriber numbers as interest rates continue to come up and then ease off, and also as we really see the worst of the economic downturn in the US and around the world. So that'll be key for Netflix. They've obviously had some big hits out recently. I watched the Glass Onion film at the weekend. I was a little bit confused by it, but I thought it was pretty enjoyable. So they've still got those key titles that are attracting subscribers to Netflix, I think.
I will say I thought Knives Out, the original, was far better. Anna, have you seen both of those films?
No, I speak with no authority on this subject, so I'll go no further.
All right, well...
I have to agree. I have to agree. The first
I'll put it on my list.
Yeah.
The first one is better.
Definitely, I would say so.
OK, well, there you have it. That's authoritative. What about the UK real estate sector, Joe? Something that I know we talk about fairly often. How can that feature? Well, does it feature for positive reasons, given a rising rates environment?
I think so, and I think that's because of how much the valuations have come down. So the valuations have come down around 35% in terms of the stock prices. And the value of property in the UK is probably only expected at the worst end to trough at around 20%. So there's already a cheapness in those stocks. And I know that Tim Craighead and the BI guys put Shaftesbury on their list. They own the West End theatres around London, so they're probably the biggest investor in that area. And there's definitely some value in those stocks, I think.
OK, still an emphasis on getting out and socialising rather than the buying stuff, perhaps, then. Joe, thank you very much. Bloomberg's Joe Easton with the latest on that Big Take story. NI Big Take is the function to use on the Bloomberg terminal to read it in full. Coming up next, President Biden's contentious border visit. More on what it means for his meeting with the Mexican president. That's looming on the agenda. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is on assignment. Let's get a look now at what's ahead today. The key market-moving events that we're watching out for this week as well. We got U.S. President Joe Biden in Mexico for the North American Leaders Summit today. And then tomorrow at 8 a.m. Eastern Time, Fed Chair Jerome Powell takes part in a panel discussion on central bank independence in Sweden. Thursday, we get U.S. inflation figures. This could be the big one, folks. Plus, was it a Christmas bonanza for UK retailers? We'll get updates from Tesco, Marks & Spencer's, as well as apparently it's ASOS, but I feel like it should be ASOS because it's as seen on screen, right? Friday, it's all about Wall Street. A host of banks are reporting earnings, including Bank America, JP Morgan, Citi, and Wells Fargo. Tons of banks coming out with Q4 earnings on Friday. Now let's get more on President Biden's trip to Mexico. He's going to meet with the Mexican president and Canadian Prime Minister Justin Trudeau as well. We're joined by Rosalind Matheson, Bloomberg Senior Executive Editor for Government. And I know, Roz, the president is going to visit the border as well. And this is a huge political topic for the U.S. What do we expect?
Well, that's right. So this meeting is what's known as the three amigos between the leaders of Canada, Mexico and the US. And of course, the relationship between those countries is arguably on a better footing since Joe Biden came to office. But there are still real issues here. And one of them, as you note, is migration. And the other one, of course, is drugs. And so you're going to see sort of pressure for some sort of tangible progress from the US president with Mexico on this issue. What he did is he recently announced a program where they will allow some migrants from some countries who apply to come in to the US, but those who just show up at the south border, they'll probably not be let in. So he's trying to placate those who are on the border states who say we can't just have people continuing to come across unhindered and allow a pathway for some migrants to come in, particularly to add to the workforce in the US. So there seems to be an understanding with Mexico that that's something that they can do. So you can expect some conversation around that. You can expect possibly an announcement that they've agreed in full to do that. But obviously also there's going to be conversations around the drug trade. And of course, the events in Brazil yesterday will come into this meeting either way.
Yeah, of course, the problem is that a lot of these migrants come in regardless of whether or not they're allowed. And the allegation is that they bring deadly drugs with them. That's the Mexico-U.S. part of it. What is Justin Trudeau going to do at this meeting?
Well, they've made clear they actually don't want to really talk about energy policy that much. And of course, that's an issue of contention with the way that the president in Mexico, López Obrador, has been pushing his nationalization, his protection of the energy industry in Mexico. And Justin Trudeau has said, well, we actually don't really need to come at that this time around. We can talk a little bit about sort of, again, migration and drug issues. But this really seems to be more of a get to know you kind of conversation and just setting the floor for some further conversations down the track. It doesn't seem as though Canada is coming with major tangibles out of this. Of course, the Mexican president wants funding for a big solar project, which is sort of on the border area with the US. So he might even hit up Canada for some of that. But it seems like the real issues here are between the US and Mexico. And of course, it's going to be sideswiped by the events in Brazil.
Yes, and let's get to those then, Ros, because you mentioned them a couple of times. I mean, how long is our attention going to be on this story? How long does it develop for, I suppose? Security services now largely in control of what's going on in Brasilia, but some in the Lula camp calling this a coup attempt. Where does this go next?
Well, that's right. And there are still quite a few Bolsonaro supporters in the vicinity, even though they've arrested about 400 and they seem to be in control now of the buildings. But of course, there's a lot to play out here. One of the big questions is what happens to Jair Bolsonaro, who's currently in the States, ostensibly on extended holiday in Orlando. Does the US need to somehow get him back to Brazil? If so, is he tied up in this? Does he face claims of that? Does he get arrested if he comes in? And how much can Lula keep all those factions at bay and start to try and enact an agenda? So there's a lot to play out here. And as we saw with the attack on the US Capitol, of course, there's a long tail to these events because beyond the immediacy of what happened, they show just how polarized the country is, a bit like the US.
Yeah, is there read across from Capitol Hill, from Washington, to what we saw in Brasilia, Ros?
Well, there are similarities and there are differences. Of course, the claim here is that some of the police officials and local officials in Brasilia possibly were complicit in this, and it was planned. It wasn't just sort of an opportunistic moment, let's go and storm some buildings in Brasilia, whereas in DC, it just seemed like the police force was overwhelmed by the size and scope of it. So that's one key difference, and how it then plays out in Brazil as they try and put federal control in the capital, as they put some of these officials to one side and say, well, hang on, is there a conspiracy here that you were involved in? So that's one key difference. But the overarching similarity is, again, these are societies and government and countries that are severely polarized, and that runs through well after these events themselves have passed, as we've seen with the recent turmoil in DC over the speakership of the House.
Ros, thanks so much for joining us. Rosalind Matheson joining us there with the outlook for Brazil and some of the North American geopolitics beyond. That is it for Early Edition. Surveillance is ahead. Tom, John and Lisa will be with you. This is Bloomberg.